Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. There's a strategy that pension funds and the ultra-wealthy use to completely defer capital gains taxes year after year while building portfolios worth hundreds of millions. It's legal, it's IRS approved, and most individual investors have never truly mastered it. Now here's the question. If institutions holding billions in real estate almost never sell, why should you? They've mastered something most of us miss entirely. Today, we're diving deep into Section 1031 of the tax code, the mechanism that adds $97.4 billion annually to U.S. GDP and supports 976,000 jobs. By the end of this episode, you'll understand why institutions never sell and how you can use the exact same strategy to defer your next six-figure gain. This is where we are in the Prime Framework research phase. You're learning the strategies that separate accumulators from true wealth builders. Let's get into it. Let me ask you something. Why do pension funds holding billions in real estate almost never sell? It's not because they can't find buyers. It's because they've mastered tax deferral as a wealth multiplication strategy. Here's the math that changes everything. Let's say you sell a property for $1 million with a $500,000 gain. Without a 1031 exchange, you're paying $150,000 to $200,000 in combined federal and state capital gains taxes. That's 30% to 40% of your gain gone. Not working for you, not generating cash flow, not appreciating. Now, what if instead of paying that $200,000 to the IRS, you kept it invested? That's the 1031 exchange. You're reinvesting 100% of your equity, not 60 or 70%. Now think about this, over 20 to 30 years, that difference compounds exponentially. We're not talking about saving a few $1,000s. We're talking about the difference between a $5 million portfolio and a $12 million portfolio. The economic impact is massive, and the data from 2019 to 2023 is fascinating. While overall real estate transactions declined by 22%, 1031 exchange volume actually increased by 15%. Investors are choosing strategic tax planning over opportunistic selling. They're thinking like institutions. That's the pension fund secret. They never sell because they never have to. They exchange, defer, reinvest, repeat, and you can do the exact same thing. So how does this actually work? Section 1031 of the Internal Revenue Code allows you to defer capital gains taxes when you exchange one investment property for another of like kind. Notice I said defer, not eliminate. You're postponing the tax bill until you eventually sell for good. Here's the critical part. You can never directly touch the money. This is the constructive receipt rule. If your sale proceeds hit your personal bank account, even for a second the exchange fails, full tax liability triggers immediately. No appeals, no do-overs. That's where the Qualified Intermediary, or QI, comes in. The QI is an independent third party who holds your sale proceeds in escrow and uses them to purchase your replacement property. They are the referee, making sure you never break that constructive receipt rule. Here's the truth, that reinvested capital is the difference between good returns and generational wealth. You're not just saving taxes, you're compounding equity that would have been lost. Now, there are two critical timelines you need to burn into your brain, 45 days and 180 days. We'll cover those in detail next episode, but the mechanism itself, it's elegant, sell through a QI, identify replacement properties, close on the new property, defer taxes, repeat. Let's bust a myth that stops too many investors from using 1031s. The myth, you must exchange into the same type of property, apartment building for apartment building, office for office. The truth, like kind, simply means real property held for investment for real property held for investment. That's it. Nearly any investment real estate within the U.S. qualifies. Want to exchange an apartment building for an office building? Valid. A single-family rental for a multifamily complex? Valid. Raw land for a retail center? Valid. A duplex for an industrial warehouse? Completely valid. My point of view is this flexibility is strategic power. You can reposition your entire portfolio, change asset classes, shift markets, adjust risk profiles, all while deferring 100% of the capital gains tax. I see investors all the time holding on to underperforming properties because they think they're stuck. You're not. The broad definition of like kind gives you the freedom to evolve your strategy without the tax consequences. We need to talk about a massive change that just supercharged this entire strategy. Earlier this year, the One Big Beautiful Bill Act was signed into law. It completely reversed the old phase down of bonus depreciation and permanently reinstated 100% bonus depreciation for qualified property acquired and placed in service after January 19th, 2025. Since we're sitting here in November 2025, any replacement property you acquire in an exchange will qualify for this 100% bonus. The old urgency of a year-end deadline is gone, replaced by a much bigger permanent opportunity. Here's why this is a game changer for 1031 exchanges. Sophisticated investors are combining exchanges with cost segregation studies, and this new 100% bonus depreciation, it's the ultimate triple threat strategy. Let me give you the new scenario. You purchase a $3 million replacement property using a 1031 exchange. You run a cost segregation study that identifies $1.2 million in accelerated components, things like flooring, electrical, and HVAC systems. Under the new 100% bonus depreciation law, that's a $1.2 million first-year deduction. You read that right. You can potentially write off the entire $1.2 million in the first year. My point of view is, in today's environment, with refinance rates around 6.3% and tighter lending, using a 1031 to defer your gain and then using 100% bonus depreciation to generate a massive paper loss against your other income. That's not just a tax tactic. That is a powerful, offensive, wealth-building strategy. The new law makes this play more valuable than ever. All right, let's recap what we covered today. 1031 exchanges are how institutions build wealth without paying capital gains. The mechanism is straightforward. Sell through a qualified intermediary, never touch the money, and buy a replacement like-kind property. Like-kind gives you massive strategic flexibility. And the new One Big Beautiful Bill Act has supercharged this by making 100% bonus depreciation permanent. Your challenge today: calculate the tax you'd owe if you sold one of your investment properties today. Here's the simple formula. Sale price minus your cost basis equals capital gain. Now, take that capital gain and multiply it by your combined tax bracket. Assume 30 to 40%. That number, that's the money you could defer using a 1031 exchange. Write it down. Have it ready for next episode. Speaking of next episode, we're revealing the 3 mistakes that cost investors over $1 million and exactly how to avoid every single one. From constructive receipt traps to the 45-day identification period most investors get wrong, we're breaking down what kills 1031 exchanges. You don't want to miss this. If you found value in today's episode, share it with another investor who needs to hear this. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.